Hello friends, this has been an unusual year for Indian equities. In the first 10 months of calendar year 25, MSCI India is up 6% versus 30% for MSCI Emerging Market Index and 17% for MSCI World Index. This is clearly the largest underperformance of Indian equities versus other countries' indices in over a decade. This has been driven by slowing domestic demand, tariff-related uncertainty, and India being touted as an anti-AI trade. The month of October seems to be bringing some semblance to Indian equities. The Nifty gained 4.5% for the month, being the fourth best performing market among the large global equity markets. This has been supported by one, robust festive demand aided by GST and income tax cuts. Second, easing global trade tensions as India and US have again started trade negotiations. And last but not the least, second quarter earnings have been better than expected. In fact, mid caps were up 5.8% and small caps were up 4.7% for the month. All sectoral indices ended higher. The realty sector was up 9%, IT up 7%, and oil and gas sector was up 6%. The second quarter result season is faring well. Amongst the BSE 500 companies that have reported earnings so far, the revenues were higher by 3% and profits by 4%, better than expectations. The upgrade in earnings is being led by consumer-facing sectors, financial services, and select capital good companies. It is a welcome and much-awaited trend reversal for corporate India earnings. Going forward, we believe the cyclical recovery in the Indian economy will continue, in fact, strengthen. The combined impact of fiscal measures like GST and income tax cut, social measures like 8th pay revision of government employees, and cash dole out by various state governments will support the domestic consumption. Likelihood of good Rabi harvest and RBI rate cut can further aid this recovery. Improving consumption demand and India-US tariff deal finalization shall result in higher capacity utilization of Indian factories and pickup in private capex. This has been a missing link of India's growth story for almost a decade now. Globally, AI trades represented by a narrow set of US tech companies and their Asian suppliers seems to be peaking. As this trade unwinds, the possibility of resumption of FPI flows to India has significantly increased. Summing up, a cyclical recovery in corporate profitability, US-India tariff deal finalization, resumption of FPI flows augur well for Indian equities. Investors should be positioned by investing in diversified equity funds such as a well-managed and growth-oriented flexi-cap fund. Within hybrid funds, equity-oriented hybrid funds can be a preferred choice. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.